So question number 46. On 1st of January, ABG Private Limited incorporated in India enter into contract to buy solar panels from A&A Associates, which is in UAE, for which the delivery is due. It's the which contract? It's then buy import contract. After 6 months on 30th of June, that means today I entered into an import contract from the UAE seller. And 6 months down the line, the contract has to get delivered now. Now the question comes, at what price? The purchase price of the panel is $50 million. You are in India. You want to import from UAE. Which currency you should have used? Either you should have imported in rupee or dirhams. UAE, that's a big cancel. No, yes, our ICI style. Don't get confused. I should have imported one among the two. Now I am importing in dollars, no problem. Is dollar generally traded in UAE? No. Is that solar panel are across the world, from which any country I buy in dollar? No. Okay, let us keep in mind that there is something oddness here in this contract. It not looks like a genuine contract. The functional currency of ABG is rupee and A&A is dirhams. The obligation to settle the contract in dollar has been evaluated to be an embedded derivative, which is not closely related to the host contract. Okay, that means you need not evaluate. All those theories you need not write. In the study material question, they only evaluated it. And they said, look, we have done the evaluation, but they are not closely related, obviously, because I am importing in dollar, which is not related to their currency only. And they say that it's not closely related. So exchange rates, they have given you spot when 1st of January. I don't know what I should do with this. 6 months forward on 1st of January, yeah, I am interested, because if I have to separate it, my host contract has to be in INR, which is currently $50 million, is in US dollars. It should be converted into INR. At which rate? The standard says on today's day, the forward rate you have to take, because that's the derivative sitting there. And the spot on 30th June, this is for settlement. Now analyze the contract and pass necessary entries. So I need to analyze this contract, some theory sitting. But should I talk about the separation criteria? Not required, because very clear language, they say it is not closely related. They didn't ask me, please analyze. If at all this sentence was missing, then probably you may have to analyze whether it is an embedded derivative and should I separate it. First of all, is there a derivative? So many analysis was needed. Followed, no? Is the host contract FETPL? All those things you should have checked. Chalo, right. On the contract date, they say analyze and pass the journal entry, no? On the date of contract, what is going to happen? The contract is evaluated as embedded derivative, not related to host contract. So if it is, evaluation has already happened, and embedded derivative is not related to host contract, therefore will be separated. The moment you talk about separation, there are two components. Correct? You have to figure out those components. What is the one component? One, host contract. Yes, are you clear about this? Will be separated up to this you have written. Okay, right? The contract has two components. One, host contract to purchase or import solar panel. What does my account index says? How should I account it? This shall be denominated, because right now it is in $50 million. I have to denominate in INR with notional payment, because it's an import means payment, correct? It's an import. So what I agreed to pay? $50 million. Now I will convert this $50 million into an INR contract. So do I pay in cash? No. Actually, in reality, I'll pay in dollar only. But notionally, for the accounting purpose, I will convert into cash, and notional payment is how much? Rupees 3,250 million. How did I get $50 million into rupees? Which rate I should consider if I have to convert into INR? 65, which is a forward rate for the future. Yes, Vidya, clear? Everyone is clear now, students? See, very important in the new syllabus, because again everything may repeat now. All RTP, MTP you scrap, because they already updated in your study material, RTP, MTPs, around 32 RTP, MTP questions. So again we are back to the 2018 scenario, where any of the questions can come. If you are not conceptual understood, and I don't know, this time they may add certain more concepts to it, they may twist it. 30 mark is your MCQ is also there. So the pattern of exams are going to change. So be conceptually very clear what this we are doing. Now second, you have got a forward contract. Now you have to tell me, students, is it a forward buy contract or a sell contract? Which is that embedded derivative sitting here? You got to see, you separated. No, one is host contract, another is the embedded derivative contract. Derivative contract is in foreign currency. Is it a forward buy or forward sell? Yes, what is your? I want everybody's opinion. No? Forward, buy, buy. Dhanashree, buy, and last, buy. Right? Forward, sell contract. This is going to cause a confusion to all the students. Now one big one. So this is one big question mark, no? Why sell forward? You are able to figure out why. I am paying in dollars, no? When we import, we pay in dollars. Followed? For paying in dollar in AFM, I will go and hedge myself by buying dollars. But actually, in reality, I pay in dollars, no? So, right, I will tell you, that is not that is simple explanation to remember. I'll tell you the real reason why we are selling dollar. Okay, sell contract at rupees 65, which you are considered here, and receive rupee. You are not convinced, I know. Followed, no? You are not convinced. I will tell you now real reason, then you get convinced. Have you written this forward contract to sell the dollars? Now only one question, sir, why sell? Okay, do one thing. First, this contract is what contract? You have importing one solar panel. You are in India. You have got rupee. You are importing from UAE in who is it, dirhams. But you are importing in dollar and paying dollar to them. This contract looked odd to you, correct? You went to the CFO of the company and told CFO, sir, I heard that you are very much good in forex and all. Is it true, sir? CFO becomes very happy. Yeah, I'm now done doctorate in this thing. What is it called? Your forex management and all. And I have taken training from Nagabhushan only. So, say for example, let us hope no. Now, then you say, sir, then what is your view about dollar? In 6 months down the line, what may happen to the dollar against INR? Then he says, 6 months down the line, dollar is going to depreciate. Mark my word. Dollar today is 60, dollar is going to come down to 50. You remember me. He sells with the pride. Followed, no? Done. That discussion is finished. You trapped him. Then you ask him, sir, I have got one doubt in one contract. Your company imported UAE from UAE in rupee. Sorry, your company imported solar panels from UAE. Either that contract should have been in rupee or that contract should have been in dirhams. Why it is done in dollar? Are you anticipating to pay less to that UAE company by entering into dollar, because you are anticipating fall in dollar, no? Now we are trapped. Now, followed, no? How much intelligent the CFO is? What CFO, if he is anticipating fall in dollars, he should go to F&O segment, take one forward sell. He is speculating. But what he intelligently did, because tomorrow, if his guess goes for a toss, instead of falling, dollar appreciates. Will auditor leave? No. You will pass one, since you have taken a short position, you will pass a derivative loss account debit to derivative financial liability. Then everybody is going to ask the CFO, what type of contract, Baba? What analysis, what your doctorate in dollars? Now what this CFO intelligently does, no? He hides this sale contract in this import. Chalo, if really dollar falls, instead of paying 3,250, you end up paying $3,000, 3,000 rupee. Your company benefited. Your guesses went toss. Instead of dollar became 70. Now 3,250 become 4,000. Will you pass a separate derivative loss? No. Your import solar panel account, which you should have been at 3,250, account debit to cash. Instead of passing this entry, you will pass solar panel account debit to 4,000 to cash. Now where this solar panel is sitting? Where this solar panel is sitting? In the balance sheet. If you make profit, followed, no? Your balance sheet will get affected. No, Baba. What you are trying to do here is a standalone derivative, which you would have entered as a speculation. You don't enter. Why? Because the effect will go to P&L account. Instead, to get the effect of that derivative, I hope you are clear, students, the crux of this. See, my anticipation is fall in the dollar, because I'm telling you this. You go in any YouTube, you don't find this explanation. This is my explanation. This strike to me. Now you are anticipating a fall in the dollar. Because of you anticipated a fall in the dollar, generally what you should do? Go and buy forward sell. But Baba, on one side you are importing. Forward sell makes no sense, no hedging. Because you will import in rupee only. But forward sell is a dollar contract. Why do you forward sell? Because the CFO is speculating that the dollar prices are going to fall down. So generally anybody, if you think tomorrow that any prices are going to fall down, say for example, land prices are going to go down, you know that, somewhere secret information you got, what you will do? Immediately you will sell your land, no? Short sell. Exactly. When the CFO thinks the dollars are going to go down, he should enter into forward sell contract right now. It's called a short sell. So that he can make a profit. But he don't want to enter into a stand-alone derivative contract. Because if you enter into a standalone derivative like a Samco, then every quarterly you have to do mark to market. If profit comes, derivative is the star of the company. That CFO is the star of the company. If really the dollar falls, what if the dollars are going to increase? He is the devil of that company. Maybe he may lose his job also. That's why what the CFO does, no, very intelligently, instead of entering into a standalone forward sell, instead of importing in INR, he decides to import in dollars. So that this benefit, he wants to get through that route. So tomorrow, if dollar really falls, his import cost will come down. What he was supposed to pay 3,250, he will pay it 3,000. Chalo, again star of the company. Asset. Now, if he makes the profit, it will be routed through asset. But if he makes the loss, which would have caught in the P&L, which the auditor would have caught in the P&L, now this time he will show in the asset balance sheet. That's why you have to apply this test and separate that embedded derivative and show what if you would have separately entered into a derivative and imported in INR. This is the concept of an embedded derivative separation. Perfect, student? Now you do, see, till now I know, students. No, my explanation is why forward sell. That's the explanation. Till now I know that you are not able to grasp fully what is the effect. I will show you at the end how it will look like. Now, are you clear why sell? So simple. In AFM, whenever I import, I forward buy, no? In accounts, forward sell. Take, remember, in exam. Or import in dollar means pay in dollar, sell. You decide what you need to remember. We don't enter, no, that if I had done, then it would have been hedged. In the question, have they told forward buy you have done? No, that means that itself tells that you are a speculation, no? If at all, you would have purchased one forward by dollar, then your intention is very clear. You have hedged yourself. That means you are importing in dollars, buying dollars from the bank. Chalo, hedged. Then your intention is very clear that you don't want to speculate. But you are importing in dollar, keeping your position open. What does that indicate, Baba? You give any explanation to the word, but what does that indicate? You want to speculate. So if you want to really speculate, enter into a separate speculative derivative transaction. Don't mix it with the import contract. Okay, chalo. Next we proceed further. The host contract. Now we have to talk about accounting. The host contract is not accounted till delivery. Why? It's an executory contract. No, he didn't send you the material. You didn't pay the advance money. There's a question of accounting. Embedded derivative is classified at FETPL because you removed now. The moment you removed both the components, one you say INR, you don't pass entry up to the delivery is going to happen. The second part you are going to classify at FETPL. Subsequently, gain or loss will be transferred to P&L account. This is when on the day of the contract. On day one, these are all the things do happen. Perfect, Nanashri? Yes. You would have not accounted only. All this headache doesn't come. Only on the day of the purchase. You hedge it, you don't hedge it, that is a separate story. Okay, that is a separate thing. Hedge means you will enter into one more derivative contract. No, you don't hedge, that itself is a speculation. If at all they would have hedged, then the hedge account is going to be applicable. Then all this separation and all won't come there. Life would have been simple, no? No, that phase. Otherwise, life would have been very simple. If you don't have a bad intentions, accounting is simple. We can call lookup passively only. We can call first PC guy. Accounting is not simple, then we need it. We are required. New generation chartered account. Okay. Are you clear? Yes. Now on delivery, what's going to happen? See, now we have written here, subsequently means every quarter MTM is going to happen. That we have written here only. On delivery, entity record purchase at rupees 3,250 million, because is that host contract value is going to change? No, no. On day one only you convert it into INR. It will remain fixed only. You separated that derivative. Otherwise, today contract value would have been different depending upon my closing rate. The embedded derivative is considered expired because it is no more applicable now, and entity record derivative gain or loss. Baba, can you tell me on the date of settlement, did I made a gain or loss? Gain. Okay, first thing, look at which contract you entered in. What is your position? Forward buy or forward sell? Sell. We have already noted, no? At what rate you agreed to sell? 65. What is the closing rate? Happy or sad? Sad, no? You have made a derivative loss there. Minus into how much? $50 million. That means derivative loss of rupees 50 million. How did you get that loss? 65 you agreed to sell, forward sell. 66 was the actual closing price. 1 rupee per dollar you lost. This is the effect, which CFO was hiding it in the purchase of solar panel there. He wanted to capitalize this. India's 21 doesn't permit me to capitalize exchange differences. This guy wants to capitalize there intelligently. The cumulative derivative liability, because now you have got a derivative liability, no, is adjusted with financial liability. When you imported, you have to pay that guy in dollars, right? Exporter of UAE. So whatever derivative liability you got, you transferred to that financial liability, because his liability you recorded at 3,250. But are you paying 3,250? No, you are paying 3,250 plus the loss what you incurred. That's why the derivative liability will transfer there. Going forward, financial liability is a US dollar denominated financial instrument. That means that vendor account, no, it is a foreign currency instrument and restated as per Ind AS 21. Finish. They're done. So the majority of the marks, if this question comes in the examination, will go for the theory what you need to write. Yes, sir, loudly. He entered into forward contract to sell at 65. And the actual rate was 66. Then I will worry. No, that means you anticipated depreciation. What reality happened is appreciation. It is sell. Since your position is sell, that's what no. Students will get confused. Written buy. Amount is same. Entry is ulta. Mark is round 0. Correct, no? Institute will look into your theory, what you are writing. This look, do you have that clarity there when you are writing? Okay, now let us pass the journal entries, accounting entries. So this is the theory we have written, what we are going to do. And this is the theory I was trying to explain you. But again, I don't think so you have grasped it fully. Let us pass the journal entry, then you see the effect. Whatever, and whenever you pass the journal entry, just see what you have written also. On 1/1/2011, since fair value of embedded derivative is 0, no entry. Post contract is executory, therefore no entry. That means you don't pass any entry on 1st January, the day you enter into contract. Why? 1, host contract is in INR and it is not it is executory. Did you supply material? No. Did you pay him advance? No. So host contract, there is no entry. Reason, it is executory contract. Embedded derivative also no entry, because the fair value is 0. You didn't pay any advance there. You didn't pay any premium. Now, is it 31st March entries are going to come? Are you listed entity? Are you listed entity? Now 31st entries are not going to come just because they have not given you the rates of 31st March. What is your assumption? No profit, no loss. If at all they have given you 31st March, embedded derivative, what you separated, no? One MTM entry you should have passed there. Sorry? No, because they didn't give the impact. That is, whichever is company, they didn't give the rate of 31st March, no. On 31st March, are you in a profitable or loss situation? Don't know. That's why no entry. Now, straight away, you move to 30th June, settlement date. If it was 31st March, rates were given, you would have passed one entry, MTM entry. Since they didn't give you, you assume that it is a no profit, no loss. Now, tell me, students, what is my first entry? On 30th June 2011, I import solar panel. What is my accounting entry? Solar panel, account debit to vendor or trade payable or financial liability, because it is a financial liability to you, contractual obligation to pay cash. How much? How much? Yeah, rupees 3250. Same, no. You already converted into INR on day one. From there, is there any variability? No. Variability would have come if you would not have removed that. Today, if you would not have removed, you should have accounted on today's exchange rate. We'll do it, no, we'll complete it. First you passed. Then, your derivative contract is going to be settled. On settlement, did you make a gain or loss? Loss. So you pass loss on derivative, which will go to P&L account. How much? 50 rupees, 50 million to derivative financial liability. Then what to do with this derivative financial liability? The standard says, the last sentence, what you have written, transfer derivative financial liability to vendor account. Going forward, your vendor becomes a dollar denominated. Even though first entry you have passed in INR, this vendor is going to become dollar denominated person. Yes, with this, we are done and solved this problem successfully. Are you clear? Now, 300. Now also I have to pay 3,300 only, you know. But what difference this makes? Under our traditional finance, traditional accounting, my balance sheet or P&L would have looked like this. There is no effect in the P&L account because I entered into an import contract. I don't pass an entry only. On the date of the import, I'll pass one entry, PPE account or solar panel account debit to payables. Correct? Today, I pass this entry. PP 3,250 only. Derivative loss in the P&L 50 and payable 3,300. If your intention is not to speculate, then I will pass this entry only. But if you have got an intention to speculate there, then I will take out that portion, account it as a derivative, show everybody in the world that somebody is hiding one error derivative as an embedded derivative. Perfect? Huh? Clear, no? Not clear. Why we are doing what we are doing. Yes. So we'll move on to the next question. Company A, Indian company whose functional currency is rupee, enters into a contract to buy machinery from unrelated local supplier company B. From where? India. Functional currency of B also in rupee. Okay, that means you are all not related parties. This transaction has not happened with related party. That means Indian guy, like from Bangalore, me, purchase something from Bangalore. Is there any odd? No. However, but the problem is the contract is denominated in USD, as if I'll go and drink one tea there and pay in dollars. Oddness comes now. In being in India, both the parties, how come you enter into a dollar contract? That means you are anticipating something in the dollar, no? Which you could have done separately, but you want to bring it and mix it with this host contract. Since the machinery is sourced from company B, B will tell one story. Sir, I am a trading partner here. Machinery is going to come from dollar. That's why you pay me in dollar. Okay. Payment is due to company B on delivery of the machine. When it's going to get delivered, we don't know right now. Now, the key terms of the contract they have given. Contract date is 9th of September. Delivery date is 31st of December. Purchase price is $1 lakh, 10 lakhs. US dollar per rupee or rupee per US dollar. It is a rupee per dollar. Don't go with the symbol what they show. Forward rate when today times 0 on 31st December is 60. This is the rate we need. Because if I want to separate it, I am going to convert it at this rate. Now, US dollar spot on 9th September 66. Spot they have given, not relevant. US dollar rate for 31st December on 30th September. Is this relevant? Why? MTM of that embedded derivative. Probably I must be closing my books on 30th September there. Previous question that problem didn't come. This time they have given you rate. And the derivative problem what we solved, no, they gave me standalone. Full value 50,000, 25,000. Here I need to calculate it. You remember the first question? Example. Now 31st December spot is given. Doesn't matter. Company A is required to analyze if the contract to purchase the machinery, which is a capital asset, from B contains an embedded derivative and whether it should be separately accounted. On the basis of guidance of 109, give necessary journal entries. Now what you are going to write? What is your understanding about this question? We have to write the impairment entries for separation. Is it theory applicable? Which theory? There are two types of theory. One theory is to judge whether separation is required. Second, if I need a separation, then how accounting is going to happen. Previous question, that separation theory we didn't write. Currency in dollar, this story. We didn't write. In this question, we have to write that. And then we have to write the theory about the account. Followed, no? Okay, so we'll write it, analysis of the contract. So, highly probable question in the exam, because I think these questions have come for the exam. Next, you have to do it. Now, purchase of machinery, right? Purchase of machinery is non-derivative host. Agreed? Machinery is a non-derivative contract. No? But includes payment in foreign currency. Machinery is a non-derivative. You should have paid fixed amount of cash for the machinery. But since you entered into a machinery purchase in dollar, this result, because of this effect, sum of the cash flow of combined instrument will vary similar to stand alone forward contract. Since you mixed one forward contract here, your entire instrument, which should have been stable because it is a non-derivative, it acts like a derivative now. Otherwise, any forward contract, like a non-derivative contract, is always stable. Its consideration and all will not change. But you mixed one derivative, entire instrument is becoming variable now. You see, this is the problem. The US dollar contract to purchase is embedded derivative. Now that the dollar purchase contract is an embedded derivative. Second question comes, should I separate? Will you say yes? You have to communicate, no? So first part we have written, what is the Embedded derivative, what is this? Okay, now write embedded derivative need separation, need not be separated when any of the one of the three condition is fulfilled. One, host is at FETPL. Now tell me, is that host is at FETPL? No, it is a capital item. Where it will go? Balance sheet. Chalo, this is failed. Second, on standalone basis, embedded derivative does not meet definition of derivative. Did it pass? On a standalone basis, that forward contract which is sitting, is it a derivative or non-derivative? It's a derivative because it's the forward contract is sitting. No, if the prices of the forward contract currency change, your contract value also will change. No initial investment you did, today you only placed an order. Settlement is going to happen in the future. So this also failed. On a standalone basis, that derivative which is sitting there, no, it is actually an embedded derivative. That's why it does not is failed. See, alternatively, if you can convert this into a positive sentence, that also you can do it. I am talking in a negative way here. Embedded derivative need not be separated, or embedded derivative has to be separated if host is not FETPL. Third, economic characteristics and risk closely relate to host. Is it closely relating or is it not closely relating? Did it pass or fail? If it closely relates, this also fails. Fail, 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 need not separate. But if followed, no? But if one passes, then you have to separate. Now you need to tell economic closely relationship. Is it closely related or not closely related? Is closely related or not closely related? Not closely related. Okay, but how do you say that? That means this also fail. If it is closely related, not separation, pass. If anyone passes, not required. But it failed, no. How do you tell it is fail? See, fail, 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 separate. But how do you tell that economic characteristics is not closely related? It is not closely related. For this, we have to write again the theory of that import. Very tricky to understand. For me, almost it came to my neck to bring it in an explainable situation. The separation rule okay, 1 minute, not separation rule, because we have applied then and there itself, no? See, we have then and there itself, we have, see, there are two ways of telling. One, you tell proper theory and then tell in the given case it is applicable like this, or post contract is measured, no, at amortized cost. So past, it is derivative, followed, no? Post contract. So we were telling that fail, fail, then and there itself. Now, economic characteristics, one, US dollar is not functional currency of either party. So you entered into US dollars. If either US dollar was functional currency of any one of the party, you would have said there is a relationship. Second, machinery is not routinely denominated in dollar. Forget that. At least both the people are in India, but you entered into contract of machinery, but across the world it is in dollar, then also we say closely related. Third, US dollar is not a common currency in India. At least in India, alternative currencies are working. Dollar also, rupee also. It should have been work. Thus, there is no economic relationship. Because of this, all the three conditions have failed. Therefore, embedded derivative need separation. Are you clear, students? So here we have explained. See, first we wrote the theory. See, first we said it need not separate. If the host is so and so, this is so and so, economic characteristics is matching. Then is that host? No, host is not classified at FETPL. Embedded derivative meets the definition. So this is fail. This is fail. We have written there only. Now the third one, we said the economic characteristics also failed because USD is not the functional currency in India. Machinery is not routinely denominated. And USD is not a commonly currency. That's why the embedded derivative, since all the primary three conditions have failed, we have to separate it. If anyone would have passed, then separation not required. Then all this accounting part we need not do. Follow? Now we will talk about the accounting. Till now, and in fact this theory, they saved us in the last question. By writing one sentence that it is evaluated to be an embedded derivative which requires separation. If they don't ask you in the examination question, then you have to write this theory. If they tell you, you say, thank God, whose face I have seen today morning, you remember. Follow? No, otherwise so many theory has to come. Now accounting, yes, this contract has two components. Now same story you are going to write. One, host to buy, purchase machinery denominated in INR. At what price? Can you tell me what is my total denominated value? I have to convert into INR, no? Because embedded derivative needs a separation. Embedded derivative needs a separation. Sorry? 6 crore 70? Yes, Dhanashri, everyone, Vidya? Yes, 6.78 crores rupees. How do you get? $10 lakhs into 67.80. Today, the forward rate applicable on the 31st December. Now, which forward contract is sitting here? Forward contract of dollar to sell or buy? Sell, because you are importing and you have agreed to pay dollar. Did you hedge yourself? No. That itself indicates that you must be speculating in dollar. At which rate? Same, 67.80. How do you classify this and this? Done, this is written. Now write host contract executed. Embedded derivative is FVTPL. Subsequently, MTM in P&L. You write a proper theory there. So we have explained on day one how we need to account this. Host is executive, so no entry. Embedded derivative is classified as FVTPL. All the subsequent changes in the MTM will go to the P&L account. So here I have written the theory for you, which is suitable for your examination. In the classroom, we will talk about only this theory. Yes, with this we will start with the journal entry. Okay, right. Accounting entries. On 9th of September 2011, no entry as fair value is 0. embedded derivative, no entry for host as it is executing. What accounting entry you need to pass now, you will explain. For host contract, we are not going to pass any accounting entry because it is the fair value, it is an executive contract. For embedded derivative, we will not pass any entry because the fair value is 0. Now tell me students, when is my next entry? 30th September. Can you tell me the journal entry what I will pass on 30th September? Can you please guide me the journal entry on 30th September? See, now will you pass any entry for host contract on 30th September? No. What will you pass for? The embedded derivative which you have separated. How? Normal embedded derivative, simple. Treat it like a normal derivative, that's Samco's case. Now, did you make a profit or loss? Okay. First of all, let us see which contract it is, buy or sell. Sell at what rate? 67.50. What is the rate on 30th September? 30th September, no? 30th September. 67.50 closing, 30th September. At what rate you agreed to sell? Is it happy or sad? You are happy, no? You have agreed to sell at a higher rate and the market prices have fell down. So what entry should come? See, entry is one among the two. There is nothing called a third entry. Entry is derivative financial gain account debit to derivative financial asset account debit to derivative gain. That I told you on day one only. Whether it is sitting as an embedded derivative, whether you do a standalone derivative, the accounting entry is one among the two. Now, to figure out that entry, you need now proper understanding about the financial instrument. What exactly happened there? What is your position? Otherwise, this answer is not evaluated. Because you write ulta entry there, loss to derivative liability, which is not the reality. This is the reality. Now comes when 31st December now, next quarter. And previous question, this entry we didn't pass. Why? Because they didn't tell me the rates. Now I'll move to 31st December. What entry I'll pass? First thing, derivative tell me, gain or loss, happy or sad? So, should I pass one entry, derivative financial asset account debit to derivative gain on 31st December? Because I am looking standalone, no. Closing balance of the asset I will transfer to the vendor. Tell me how much is my gain or loss? $5 lakhs, $6 lakhs. Okay, so how did I get the gain of 5 lakhs? See, $10 lakhs is the total value. At what rate I agreed to sell? That is before MTM. Since you already considered MTM here, now new value is 67.5. 67.8 is no more relevant to you because you already marked that. You have already written off. So it is 67.5 minus 67. So you agreed to sell at 67.5, but the actual price is 67. This gives you one quarterly profit. Alternatively, if you want to the cumulative basis, 67.8 minus 67 minus the previous loss, previous gain. One and the same, your choice. Nobody can confuse you when you understand both the ways of doing it. That's what in the first example I showed you, cumulative also, I showed you standalone also. Now is there any more entries? Yes, PP comes to you. So you pass PP account debit, how much? 6.78 crores or 6 crores 78 lakhs. Vendor how much? This is a 6.78 only. But what you will do with this derivative asset? You will transfer to the vendor. So can I say PP to company, creditor 6.7, derivative asset is 8 because 5 plus 3. Alternatively, you can do like this: PP to vendor 6.78 and then vendor to derivative asset 8. If you want, you can split this entry into 2. Done. Such a simple accounting. The theory is the maximum portion. So theory, they may ask you on a standalone accounting basis. They may ask you to separate it and pass it. I hope we are very clear about whatever we have discussed today. So we'll move on to the next question. Entity A whose INR currency entered into dollar for sale contract on 1st of January. Understand, both the previous questions were import. So my embedded derivative was forward sale. This time I have exported. Embedded derivative is forward buy. With the entity B, that also INR, to sell the equipment on 30th June, when on 1st of January. So spot they have given you on 1st of January, not required. What I should do with the spot? 6-month forward rate on, this is what I need to convert. Spot rate on 31st March, why it is needed? Not required. It's like the same story I told you, your friend's wedding. Now on 3 months forward 45, yes, I need this for MTM to compare with this. Now spot rate on, this I need for the settlement. Sometime in the examination question they may give you spot also, forward also. Then forward, not spot. Spot will never consider. Now assume that in this contract embedded derivative is not closely. Feels good, no? Otherwise, sit and write all the story. Host is FETPL, embedded derivative, standalone basis, characteristics test. Not required. Please provide the detailed journal entry in the books of A for accounting such embedded derivative unless the sale is actually made. Now, what they have done here in this question, in the solution, question is silent, but in the solution they have given a table summarizing the gain or loss as a working mode. So in the examination, if this question comes, just see if they ask you summarized value of a table. Previous question we didn't do, no one working. If you want, you can do it for the previous question also. That's your choice. We will do one working here. Okay. First part, you can leave some space. Theory. So first I start with the theory. Contract has got 2 components. Contract to sell. At what rate? 55. Please look into the rates. Are you clear? So I will convert $10 lakh into 65. 5.5 crores is my value. And there is one embedded forward delivery. Post contract is not accounted till delivery. Embedded derivative FVTPL, and for embedded derivative is a forward buy. Clear? Why buy? Because it's an export. At what rate? 55. Then on delivery, entity records the sale. Customer account debit to sales revenue. Embedded derivative is expired, and derivative is adjusted to the customer account. So that customer is going to become whatever, customer or vendor. You are going to adjust the last balance. So leave some, and the carrying amount of the customer will be new for $50,000. Carrying amount of the dollar forward buy contract on the maturity is $50 lakh. Okay, anyhow, we will solve the problem through one table. So leave some 7-8 lines just to write the theory. Please write it going home without seeing, so that you get a practice how to express that theory in the form of this. Okay, write a table summarizing the gain or loss. Heading will be date, transaction, sales, debtor, derivative, asset or liability, P&L. It's like a journal entries. There are 2 journal entries. One, derivative asset liability. Second, sales and debtor. So on 1st of January 2011, you have got sale with embedded derivative. Will you pass any sales entry, debtor entry, derivative entry, P&L effect? No. That's what you said. On the day we enter into contract, we don't pass any entries. Now comes 31st March 11. Will you pass any entry? Yes, MTM. So did I made gain or loss? That's what I am trying to ask. Hmm? Did I? Huh? Gain. This has nothing to do with accounting. Huh? Yes, Vidya, what is your opinion? Loss, everyone? At what rate you agreed to buy? Your contract is forward buy. And what is the rate on 31st March applicable to the settlement date? 45. So your contract is to buy and the prices fell down. You made a loss. So how much is your loss? $1 million into 55 minus 45. 10. 1 crore. 1 crore is the loss, liability, and P&L profit, loss you debit, profit you credit. So you can give this sign, or you can write here debit credit also, doesn't matter. Followed, no? Your accounting entry will be P&L account debit to derivative financial liability. If you want, you can write, give that sign. Yes, are you clear, Prithvi? Now comes 30th of June 2011. Again there is an MTM. Are you have loss or gain? Gain. Why? Because you previously scrapped it MTM at 45. So $1 million into how much? 60 minus 45. So you are happy now because already you booked the loss. Now the prices have increased more than that. So how much is the gain? 1 crore 50 lakhs. So this is the summarized table which they are going to ask you. Exam, they don't ask, leave it. Or remember the question, both the parties in India, embedded derivative theory not required to be written, do this table. If embedded derivative theory is to be written, this table not required. Then you pass the sales entry. What is my sales entry? I will tell the entry. Debtor account debit to sales. Amount. Can you tell me the amount? Huh? 5.5 crore, no? Already we have told initially. So 5 crore, 50 lakhs. Negative credit balance. 5 crore, 50 lakhs. This is 5 crore 50, 5 crore 50. Then embedded derivative settlement. What is the closing balance of the derivative asset or liability? Do you have got asset or liability? Asset. So make it negative. Credit 50 lakhs and debit debtor 50 lakhs. Are you clear? Yes, sure. So please pause the video and pass the journal entries. You got all the values in your hand, no? Just journal entries. Yes, please pause the video and pass the journal entry. Yeah, okay, sure. So we'll compare the answers. Now on 1st of January, no entry. On 31st March, P&L derivative loss to derivative financial liability 1 crore. On 30th June, derivative financial asset, derivative financial liability to derivative gain. Will you pass this entry? And see, this is coming from that derivative chapter. Nothing to do with the embedded derivative there. Trade receivables to sales and trade receivables to derivative financial asset. So in the first question I showed you, like why we are doing this, why the test is needed. And till now, only from the derivative that one SAMCO questions come for the exam. None of these questions have come for the exam. So there are high chances that an embedded derivative question may come for your examination. Till now in the old syllabus, this question has not come. Followed, no? Okay, don't, it's a very simple, right? Simple, agree with me? Because if you look, it is complicated, then there is a problem. You may not study that, you may not prepare for it. And if it comes at least 10 to 12 marks, it may come. So study it. I showed you. Only, first you give only these questions, you study thoroughly. I have given the answer keys also, how to write. Yes. Next, we will see one more question. Again, this question has not come in our old syllabus, but this is only one question on that another type of embedded derivative, where I said no prepayment option is equal to amortized cost. Now, entity PQR borrows 100 crore from HDFC Bank. Okay, let us simplify it. CFDH Bank, no? They confused us. HDFC Bank. On 1st of April. Okay. When you borrow, it's a financial liability for you. Interest is payable at the 12% per annum, and the bullet repayment of the principal at the end of the loan and term is 6%. Seems to be normal. This is a conventional bond. Only question is it an at the market or off market? That's what I need to check. The loan includes an option to prepay the loan at 1st April every year with a penalty of 3%. That means any point of time I can prepay this. See, this is a bullet loan, 100 crore. When I am supposed to pay this? End of 5th year, 6th year. Till that every year I have to pay 12% rate. No, is that a market terms or off market term? How do you know? Because if you go to the next question, without prepayment option, interest is 11%. Normally I should have paid 11%. Then why? Which snake has bitten me to buy from this HDFC Bank at 12%? No, no snake has bitten. But there is one element of option hidden or embedded in this loan contract. Now, HDFC Bank also knows the buyer is very smart. If the interest is going to increase more than 11% or 12%, I will not repay only. But tomorrow, if the interest becomes 5%, instantly I will repay this loan back to HDFC and I will take new loan at 5%. That's why they gave me, and my cost of this option is 12 minus 11% plus 3% penalty. That is the price what I am paying to this option. Now, is that option an embedded derivative? Is the host contract, okay, for this we have to, that's for separation rules we have to check, no? First rule is what? First rule is what? Little tricky, okay, this question, but you have to understand one particular answer, write the way what they have written. I'll tell you. First rule is what? The contract should be host contract. What is my host contract? Loan. Is this loan FVTPL? No, it is at amortized cost. No. Financial liability is at amortized cost. Second, on a standalone basis, this option to prepay, is it a derivative? Yes. Why? Because we know that interest rate and the market value is inversely related. So when the interest is going to fall, the value of this loan is going to raise. And that benefit I can get by prepaying the loan. So that's why my option has got a value, and the values, options value changes depending upon the change in the interest rates in the market. Interest rate is underlying there for this option, because of which the value of the rate changes, because either I can repay or need not repay. If interest rate is 15%, the option is very high for me. It's valuable. Followed, no? Because I need not repay. Otherwise, I have to repay. And third, is there an economic characteristics test? Is that options character versus the loans character is matching? For this, we have to test that the prepayment amount approximately should be equal to the amortized cost of the loan. So I need to prepare one amortization schedule by discounting the cash flows at 12%, at 11% of market terms, and check the closing balance with the, any point of time the prepayment. That's it, simple. Okay, clear, no? That's it. Okay, for understanding purpose, what is my initial entry? 1 minute, what I have told. My entry would be bank to loan payable. Now, bank account debit, prepayment to loan payment. Which is my initial entry? Should I pass this entry? Should I pass this entry? Because see, if I have to see, my loan payable should be stated at a fair value. Fair value is the present value of the future cash flows at the market rate of interest, which is 11%. If I discount at 11%, then it will come to 104.22. And that is, this entry is going to come only when I am separating that prepayment embedded derivative. And if I don't want to separate, then both the things I club together, asset and liability I'll club together and pass single entry. The question here is, should I pass this entry or should I pass this entry? Then you say, sir, for this we will apply the rules. No. Without applying rules, how can I say whether should I pass this entry or should I pass this entry? If the rules give me the result and say separate, I will go for this entry. If the rules say that need not separate, I'll pass this entry. Simple. Did they ask me? They didn't ask me. I'm just telling you for you to understand why we have to apply the rule. Okay, first write economic characteristics. We'll go to that. Oh, no, wait. Economic characteristics for understanding only. This solution is not come. Prepayment option is embedded, it's closely related if the option exercise price approximately equal to the book value of the loan at any point of time. So for this I need an amortization schedule. Okay, it passes, then you need not separate. If you need not separate, that means bank to loan 100 crore. Right, step 1. And if this question comes, you have to write this way only, because they are all study material, they are told step 1, step 2. Identify the host and embedded derivative. Yes, please. This is not required because any already told, already discussed, it's given in your book also. Again, we are going to write later. This for your understanding, I just showed you. First, step 1, identify the host and embedded derivative. Now, you'll ask me, sir, what is this? Why we are writing like this? There are only few questions, including in your AFM and here, where steps you have to write. If this question comes, answer in this format only. I don't know what verb they are going to use. Compare, contrast, God knows what they will tell. Now, in the given case, host contract, host contract is debt with the annual interest plus bullet repayment. So host contract is a debt which has got an interest payment plus bullet repayment. Second, embedded derivative is option to prepay. Who is enjoying this option? The borrower. What is the cost of this? 1% plus 3%. Now, we need not talk about the first two definitions here, because in the study material also they have not discussed whether the host contract is FETPL, whether embedded derivative on its standalone basis is matching. We will forget. Straight away we will go into the economic characteristic test. Economic characteristic test. A prepayment option in host debt is closely related if option exercise price, see, for your understanding I showed in the form of a picture there, option price approximately equal to, but in exam you can't write like that, you have to write in a proper English. Exercise price is approximately equal on each exercise date to, don't write book value, amortized cost. You can say book value, but it's a layman language. Amortized cost is an Ind AS language. of host debt. Ah, nice language, no? People will become afraid. When your client comes, no, in front of the client, you should speak like this. Oh, there is one embedded derivative contract in the host contract. The separation rules when we apply. Then you think, oh, somebody very big person has come and talking big things. In layman language also we can explain it, but we should not do it for outside world. This is our trade secret. Then people say, oh, only that much? Ashtaya. What the big deal there? Layman language we will understand inside the classroom. Followed, no? So you are going to write. So to test this, what do you need now? Step 2, right? You need something, amortized cost. See, you know what is the exercise price? What is the exercise price? 100 plus 3% penalty, no? 103. So anytime you want to repay, how much you need to repay? 103. But to compare that with the amortized cost, do you know the amortized balance? No. That's why we have to do an amortized cost now. Sorry? 12% is the interest every year you pay. Suppose if you want to repay, you wait up to 6 years, repay me 100. In between you want to repay, pay me 103. Because 3% is the penalty over that 100. Once I repay, there is no more interest, no. Once and full settlement I will do, 103 I will pay, finish. Next year interest doesn't come there. Let loan itself got closed, no. Okay. Amortized cost is the present value of, see, I need an amortization schedule. For that amortization schedule, I need an amortized cost. Present value of CCF at market rate 11%. Yes, please. Embedded derivative from the host. If anyone passes, then we need not separate. I will pass the first entry, bank account debit to loan. Anyone fulfills. Okay, let us apply. In the question they didn't ask. First condition is what? Host is FVTPL. Did it pass? No, because host is amortized cost. Fail. Second, your derivative, embedded derivative is actually a derivative. Yes, yes, because we see that prepayment option has got a value. Because you can sell this to somebody. It has got a value because of the inverse relationship. Yes, this also fail. The third is economic characteristic test. That's what we are testing. If anyone, then I'll pass the entry bank account debit to loan 100. If it fails all, then I will pass that entry and I'll separate this embedded derivative and do MTM every time. Because this is an odd contract, no? So, what is my fair value of the loan now? Amortized cost or fair value? On initial recognition. Therefore, fair value is equal to, how much is the principal? Rupees 100. When should I pay this? 6 years down the line. At 11%, what is my present value factor? At 6% for 6 years, 0.5346. This gives me 53.45. Interest is how much? 12 rupees. Interest is 12 rupees. Into present value annuity factor is 4.2305. 11% present value factor. Oh, sorry, this one. 11% is the present value factor. But interest contractual cash flow is 12%. So I have done it in this format, but by now I hope you are very good at this. So this is the amortized cost on the day one, or you can also call it a fair value of the loan. Determine the fair value of the loan. Now I need to prepare an amortization schedule, compare it with the prepayment value. See, if in the study material, no, they are given more things, but rather than understanding everything and getting confused, if at all, worst case scenario, because in the last 11 attempts this didn't come, chances are low. But if it comes, do it fast. You can take a risk of 1 or 2 marks. You may not write about that host contract, FVTPL and all those story. Leave it. Followed, no? Yes. Next, compare exercise price with the amortized cost. For this, you need to prepare an amortization schedule and have 3 more columns. You need an amortization schedule. At the same time, add 3 more columns extra so that you compare and find the difference. You are very clear, no? Whatever questions. And that's it. There are no more, many questions are not there, very limited. And in fact, RTP, MTP and all, so many times it has come, but it's the same question which has come. This question is hiding. Anytime they may ask you. Okay, first I start with the year. 1, 2, 3, 4, 5, 6. What's my opening balance? 104.22, fair value of the loan. Amortization should happen at EIR. What is my EIR? 11%, 11.46, not the 12% what I pay. Contractually, how much I pay? 12. So closing balance 103.68. On this day, at the end of the first year, the amortized cost is 103.68. What is my exercise price if I want to repay at the end of the first year only? 103, 100 plus 3% penalty. How much is the difference? 0.68. If I have to find the percentage of difference on the amortized cost, it comes to 0.70. Is it approximately 103 is approximately equal to 103.68? Yeah. Repayment comes 108. Amortized cost is 103. Then I will not pay. That means host characteristics are not matching there. I say please separate. But if it is almost similar, that means it's the general business transaction. But if it is totally different, that means you are trying to do something. Understood the meaning, no? If suddenly this repayment comes 108, balance is 3, repayment is 8, that means on day 1 only I know that you will never pay me. That means that option premium was something different. In the name of an option contract I gave, but I know that you will never exercise this option. That means characteristics is different, no? To it's what it is, separate it. Any 1 year if you find this difference, separate it. Any 1 year. You go to the second year, what is the opening balance of the loan? 103.68. Interest will be 11.41. 12 you repay. Amortized cost will be 103.09. Again same story. You have to compare it with the any point of time with the repayment amount. 103 only all time. So now you can fill in the blanks. Difference comes to 0.09. Again 0.1% difference. See, leave it. So like this you just fill the numbers. Huh? You know amortization schedule. So write 102.43, 101.70, 100.9 dash, because you repay by last year. Anyhow, there is no last year. The option has got no value only. Option has got value till the time of its expiry. On that last day, there is an option value. So students, you can pause the video, write all the 103, find the differences and find the percentages. So you get different percentages like this: 0.7, 0.1, minus 0.6, 1.3 and 2.1. 1 year you see one big difference. Now question comes, is this 2% acceptable or not? That management has to decide. So in the examination question, if it comes more than 2% is bigger difference, then your conclusion is separated. Right now the question is very silent now. So you give one diplomatic answer. If the management decides that 2% is substantial, separate. No, don't separate. Are you clear? Let's write the conclusion. The management shall formulate policy to determine what is approximately equal. Management should form, because accounting standard cannot say. That may change from organization to organization, country to country, in one country, place to place. 1% can be a very big amount, one remote area, say one particular state. That 1% is chiller in Mumbai. Yeah, they say, what is this 1%? Why you are crying for 1%? But same 1%, somebody in a remote state, somebody will cry. Yes, sir, that's a big amount. So you have to define an accounting policy considering your circumstances and the jurisdiction. In case, if management define 2% or more, is not approximate equal. If the management decides that 2% or more is not approximately equal, then embedded derivative need separation, else not required. And if it needs separation, then you need to pass one accounting entry, bank account debit 100, prepayment option account debit 4 point whatever, to loan 104. Then going forward, loan will be amortized cost, the prepayment option will be MTM. That's it. So this is the theory you have to write in the examination. Okay, so there are some more theory, but for time being, let us not break our head. Clear? So the journal entry not asked in the examination question. If it needs separation, we are going to do this. They didn't ask. If they, and we have to subsequently measure FVTPL, and loan will be amortized at 11%. And if it's no separation, then to a bank to loan payable, amortization will be 12%, because this is with the 12%. No? Yes, with this we are successfully done derivative chapter. Yes. MTM previous, no, they will not ask you the MTM. First of all, again, understand this question has never come, and that chances that they will ask you pass the MTM entries, because such type of guidance is not there. Chalo, worst case scenario it has come also. See, my suggestion is don't touch that. You are simply wasting your time there. Just move on, and it may come for 5 marks. Take risk. No, you are writing in not 100, no, 120 you are writing. And if you write theory and all, then you are actually attempting proper marks. See, most of the students simply say, I have attempted in 80. But without their knowledge, they don't know. They must have attempted 60 because theory not written only. They may not be aware only the theory is to be written. Followed, no? So understand the question, address. I'm telling you, FR 60 is not a big deal only. Aram say you can, but your strategy should be there. Speed should be there. Clarity or thinking should be there. Procedural questions are very 10 to 15% only. Then a question may get repeated, but a twist will be there. That is a conceptual question. Are you clear? Yes. So the next aspect is on the impairment.